According to an August 31st article in the Wall Street Journal, stocks have suffered their worst August in a decade. It's chicken licking time.
I'm here to tell you that the sky is falling.
I'm not here to tell you that the economy is in great shape, but let's step back and look at what we've been through over the past 80 some odd years.
Here's a chart that shows a number of events that happened here in the United States and around the world from 1927 through 2008. We had the Great Depression and the market crash in 1929, Pearl Harbor 1941 and World War II running through 1945, the Kennedy assassination in 1963, Watergate and the Nixon resignation 72, 73, 74, Black Monday, October 19th, 1987, Desert Storm, 1991, and of course in 2001 we had 9/11, and then the credit crisis in 2008. Had you invested $1 in the market in 1927 and just invested in the S&P 500 index, you would have had a return of about 8.8%. Now, it is true that you cannot invest directly into the 500 index, but you can invest in a surrogate. So anybody who invested here and jumped out of the market in the early 1930s would have lost all the upside of this market.
Let's take a look at a couple of these events from the previous graph and look at them in detail.
Here's a look at the demise of the Nixon administration, January 11th, 1973 through December 6th, 1974, a total of 694 days. The Dow Jones Industrial Average started at about 1,052 and ended at 578, for a total loss of 45.1%. Had you bailed out during this tumultuous time of the Nixon demise, look at all the upside of the market that you would have missed. Here's another look at a time when the markets were tanking, January 15, 2000 through October 19, 2002. This was the tech crash, $5 trillion lost in market value. Total of almost 1,000 days. The Dow Jones started at about 11,800, ended at about 7,300, for a total loss of almost 38%. Look what would have happened had you bailed out of this when at the beginning of 2000 you would have locked in your losses. But had you stayed in this market, you would have had a decent return over this time period. Look at here. We had an upside of 568%. And on the Farmer French U.S. Large Value Research, we had a downside of 76%. So in any one year, we can have this very large volatility going on in the market. But look what happens over time. That volatility smooths out. And after 20 years, there's not much volatility at all. Now you may say, but I don't have 20 years to invest. Consider this. A married couple, each of whom is 65 years old, the probability that one of them will live into their 90s is 50%. There's nothing new as to what's going on today with respect to the market. It's called market volatility. It happens all the time. Markets go up, markets go down, markets move sideways. We don't know where the next 20% move is going to be, but we do know that the next 100% move is always up. Our clients are diversified in over 12,000 companies in 42 different countries. We would take a global catastrophe for us to lose everything. You're not going to sell your home just because housing prices are down, so neither would you do it with your portfolio.
In order for you not to get wrapped up in the crisis du jour, here is your to-do list.
Here's your to-do list. Turn off the hype, focus on the long term, attend our next education session, and if you have questions, call me. Trust in the process.